This is Bible School Radio, KDKR, Decatur, Dallas, Fort Worth, KYJC, Commerce, and KMWC, Bethany. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, could someone get away with not paying taxes? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, according to social media, there are many ways that you can get out of paying taxes. However, is that advice that might just get you into trouble? Today, IRS Expert Dan PIlla is here to weigh in. Hey, Dan, welcome to Prudent Money.
Hey, Bob. Thanks for having me. How you doing?
I'm good. You know, I was thinking about this. We've done hundreds of interviews or talks or programs together through many, many years. And I don't think we've ever really addressed what we're going to talk about today. So I want to warn you ahead of time, because you and I don't really discuss what we're going to talk about. I usually give you questions when you get on the air. This might make you a little bit crazy today, because I know how I know how I react when I hear unrealistic bad financial advice. And it is amazing to me, especially on social media, how much bad advice is given about how to deal with the IRS, how to get out of, even using the word evade taxes.
Well, it is astonishing, Bob, and these arguments, these theories are like garden weeds. You know, I've spent literally over 4 decades battling this stuff. I can't tell you how many different research reports and newsletter articles and articles for public consumption that I've written in major outlets like National Review that do my best to debunk this stuff to keep people from getting in trouble. But the fact of the matter is, you never have to plant seeds in your garden to get weeds. You got to be out there weeding all the time to get the stuff out of there. And that's what these arguments are like. They just seem to come out of nowhere. And the minute I get done with a report or an article or something that debunks something, then something else pops up somewhere else that's kind of a first cousin or even a third or fourth cousin to the argument that I just debunked. And not only that, but years ago, and I can't tell you how many years ago, but it's been 20 years. The IRS started publishing on its website its list of so-called dirty dozen tax scams. Actually, the dirty dozen is not quite that old, but there is a list that's older than that talks about and identifies the specific what the IRS calls frivolous tax positions. All right. So if you go on the IRS's website, irs.gov, and in the search box you write in frivolous tax positions, you will get a very, very detailed analysis of what the IRS considers to be frivolous positions that a person can claim on a tax return or in connection with a claim for refund. And if you make one of those arguments on a tax return, Bob, you open yourself up to a $5,000 penalty under the Internal Revenue Code for asserting a frivolous position with the IRS. And it's funny because that's the statement that's about 20 years old or so, maybe even older. I offered to write that for the IRS, or at least help them write it, but they didn't take me up on that.
Can't imagine why.
But the point is, Bob, that if a listener is exposed to some of these arguments, to any of these arguments that take the position that you don't owe income taxes, that the tax system is a fraud, that the 13th Amendment was never ratified, that it's a violation of the Constitution, any of these kinds of arguments, then by all means I encourage you to go to the IRS's website and look at that paper on frivolous tax positions, and also go to my website, taxhelponline.com. I have a research report there called the Untaxed Promise, and that's a free report, and it's downloadable, and you read through that, and I go through probably 7 or 8 of the most common so-called untaxing arguments that are out there that say, well, if you do this and you wave your wand over here and you sprinkle the pixie dust over there, you're not going to have a tax liability anymore. It'll go away. Well, I debunked those in my own report. So you can't. You cannot take these things at face value and believe that just because somebody on the internet says you can do this or that you can legally do this or that, because you're really just asking for trouble.
So is it a fair statement to say that if you look at the tax code, it's very black and white? I mean, there's no playing in the gray. Yeah, comment?
No, you can't really say that. There's a lot of ambiguity in the Internal Revenue Code, and there's a lot. We'll put it this way: even to the extent that you can argue it's black and white, which I don't think you can make that argument. But even if you did, the fact of the matter is that the scope of the code is so vast, and the cross references
right.
are so elaborate and extensive that it is very, very difficult for a person to work their way through these various provisions and make some sense out of them.
Okay, so let's start with one that I found a lot of references to over social media, and it starts with a guy approaching a gentleman in a Ferrari, and he just bought this Ferrari out of cash, and he started questioning him. He goes, I made $7.1 million this year, and I didn't pay any taxes. And so he starts with the Augusta rule. And this is where you rent out your house to your corporation 14 days out of the year and save taxes. Do you see people actually using that?
Well, that's a real thing, Bob. The so-called Augusta rule is a real thing. It's a provision of the Internal Revenue Code. If you've got a piece of property that you own, that you rent out for fewer than 14 days out of the year, then the rental income is not taxable. That is true. Now, whether a guy can go out and buy a Ferrari as a result of that, I guess it depends on the house, and it depends on how many years you've been renting it out. What does a Ferrari cost these days, Bob? $200,000, $300,000? I don't know. I suppose it depends on what kind of Ferrari you get. But there just aren't that many houses that are going to rent for that much money over a 14-day period of time. I suppose if you stash every nickel over a 20-year period of time, well, maybe you can get yourself a Ferrari with tax-free rental income. But it's just, generally speaking, we're not talking about that much money.
Now, let's talk a little bit about, this is a one that I came across quite a bit, is place your children on the payroll. And you go and you establish a separate management company to avoid payroll taxes. The IRS would have a big issue with that, wouldn't they?
Well, here's the thing: if you've got a small business, any business, and you hire an employee, you hire a worker, then what happens is, as the employer, you have to withhold from that worker's salary their federal income tax, and you pay as the employer, you pay the withheld money to the IRS on behalf of the employee, right? That's the withholding tax. Every employee in America knows about that. The employer also has to withhold the Social Security taxes and the unemployment taxes for that person. And the unemployment tax is not withholding. They have to withhold the Social Security tax for that person, and then the employer has to match the Social Security tax and pay the unemployment tax. All right, those are called employment tax liability. So you got the workers' withheld income tax, and then you got the Social Security tax and the employer's Social Security tax. That all goes in. If you've got a child that's under the age of 18 that you put on the payroll for your business, that child is not subject to Social Security taxes. They are subject to income taxes, but not Social Security taxes. And so as an employee of your business, these children can perform services for the business and get paid fair market value for their services. They do owe the income tax, but they don't owe the Social Security tax. So what that advantage does is it gives the the parents of the child an opportunity to pay money to the child, legitimate payment for legitimate services rendered, and that child then uses the money for whatever they use the money for. And as a matter of fact, parents can dictate how the money is to be used. It's going to be school supplies, it's going to be school clothes, it's going to be this or that. And so what happens is the parents legitimately get a tax deduction for the wages paid to the child. The child doesn't pay income tax on it as long as it's below the exemption level, right? You're allowed to earn as a single person up to about $12,500 a year before you have to pay any income taxes, and then there's no Social Security tax on it. So that's a legitimate strategy. But here's where the problem comes in. The problem comes in that you have to, if you're paying the child, you have to demonstrate that the child performed legitimate services for the company, and the payment to the child was based on the fair market value of the services. So you can't pay a 10-year-old kid $3,000 a month to do the IT for your business. No one's going to believe that, right?
Right.
Nobody's going to believe that. And so you have to be able to demonstrate legitimate services and compensation that's fair market value for those services. So if you've got a child that's stuffing envelopes, for example, and we're talking about a 10 or 12-year-old kid, well, what kind of educational background does it take to stuff envelopes and put stamps on? Not that much. But on the other hand, you're not paying that kid $1,000 a month to stuff envelopes either, right?
Right.
So that's the trap that people fall into, is they think, oh, I'll just put my 15-year-old kid on the payroll and pay him $5,000 a month, and this will be great. We'll pay for his college that way. Well, that's not going to work.
Let's talk a little bit about some of these are legit write-offs, but people take it a little too far. Talk about the specifics of the home office.
Yeah, the law is clear that a space that's used in your home for business purposes becomes a deduction. What I mean by that is, to the extent that you have, let's just say you got a 1,000 square foot home and you're using 2,000 feet of that home for business purposes. All right, so that means you're using 20% of the home as a home office. Well, now what happens is 20% of the real estate taxes become a business expense. 20% of the interest becomes a business expense. You've got some potential depreciation that's available now based on the value of the home. You've got all of the utilities and maintenance on the home that become deductible at the rate of 20%, right? The business use percentage in my example is 20%. So those all become deductible, and that's all perfectly legitimate, but here's the hitch. There's always a hitch with this stuff, Bob. Here's the hitch. When we're talking about a home office, the space in the home has to be used regularly and exclusively for business purposes. All right? That means that if you've got this spare bedroom that you're using for your office, you can't use it as an office during the daytime and a TV room for the kids at night, or it can't be the extra bedroom for the college kids that come home on the weekends and now they stay in the office. The office has got regular and exclusive. Note the word exclusive. It can't be used for anything else. It can only be used for business purposes. All right, and there is the hitch there that it's got to be that exclusive use test and the IRS is very, very serious about this. Obviously, it's a provision of the law, and so if they do an audit on somebody that's claiming a home office, they're going to ask about this exclusive use, and you're going to have to be able to understand what they're asking you about, right? Number one, and number two, answer the question clearly as to what other activities are going on in that room, and the answer better be none. It's exclusively business. Now, here's another problem, Bob. Let's say you got husband and wife that each have their own business, right? Husband is a home-based IT professional, and wife is a real estate professional. Let's just say that this is not an uncommon scenario where both husband and wife are self-employed, and they have one office space in their house, and they're sharing the office. Now, think about this. Each business has to meet the exclusive use test. It's not exclusive use for businesses, plural. Sure. It's exclusive use for your business. So if I'm sharing my home office with my wife, The fact that she's using my office cancels out my home office deduction, and the fact that I'm using the office cancels out her home office deduction, because it's no longer exclusive use, right?
Right.
And you say, well, Dan, but it's both business, but it's different businesses, Bob. There's different businesses that are being operated differently and producing income differently, and each one has to meet the exclusive use test. So you'd be surprised how many people get in trouble with that little nuance. And so what has to happen is if you have a space in your home that is being used by both husband and wife, it's got to be clearly delineated. Now, you don't need to paint a line down the middle of the floor, or you don't have to have a curtain necessarily that delineates the two office spaces, but there has to be clear separation. And so now if we're talking about 200 feet of office space, right, the spare bedroom, now the wife gets 100 feet and the husband gets 100 feet. They both can't claim 200 feet.
So talk a little bit about, one of the things that that can be legit advice is, write off everything. How do you legally write off, cell phones, computers, when there's a personal element there as well?
Well, the short answer is you can't. All right, when you say write off everything, that your bells and whistles should go off anytime somebody says write off everything, because when we're talking about business expenses, all right, there is a code section that very clearly talks about what can be written off as a business expense. All right, and the expense has to be incurred for the purposes of earning income, and it has to be reasonable, and it has to be incurred in connection with an activity that's engaged in for profit, right? So you can't write off everything. What you can write off are expenses necessary to earn income. Now, you hit on a very significant problem here, and that is, what happens when you got your computer at home and you got your cell phone and you're doing business on the cell phone, but you're also using the cell phone for personal purposes. Well, that's a situation where you have to make a good faith effort to distinguish between personal use and business use. So if you are legitimately using your cell phone 100% for business, then it's 100% deductible. If you are legitimately using your cell phone 70% for business and 30% for personal, then you've got a 70% deduction. So the question is, what is the percentage of business use? That's the key phrase in all of these, we call them mixed-use properties, right? Things that automobile is a perfect example of a mixed-use property. All right, yeah, you use your car for business, but you also, drive to the grocery store, and you also go out to dinner with your wife on Saturday night, and you do these various personal things with the same car. So it's a mixed-use piece of property, and you have a responsibility to distinguish business use versus personal use, and you can only write off the business use portion.
Let's talk a little bit. Let's backtrack a little bit. Talk about the car. If someone is there limitations on how much money you can spend on an item and legitimately use it for that business. So let's say that, hey, I want to go out and buy a Porsche and write it off as a company car. Could you legally do that?
Well, remember what I said about the three rules. All right, it's got to be an expense. It's got to be an expense that's ordinary and necessary. It's got to be incurred for the purposes of earning income, and then it's got to be reasonable. All right. So in a situation where somebody buys a Porsche, it very well could be tax deductible, Bob, depending on what business they're in.
Sure.
Is it ordinary and necessary for the type of business that person is in, and is it reasonable under the circumstances based on the business that they're in? If you're a real estate professional, I mean, this is a perfect example. If you're a real estate professional and you specialize in high-end clients that are buying and selling high-end properties, right? We're talking $2, $3, $4 million houses. And I got a friend here in Minneapolis that always seems to land the professional athlete, right, as their client. And so, the new athlete comes into town, they sign their $15 million deal, and the first thing they want to do is go buy a $3 million house, right?
Right.
and down in Dallas it might be a $6 or $7 million house. But anyway, the point is that I don't know how this guy got himself in this niche, but there he is. He's dealing with these professional athletes. So these professional athletes come to town and they got their wife. Sometimes plural, sometimes multiple wives, but never in the car at the same time. You understand that problem, but the point is that this guy's got he's got the highest end Cadillac SUV that money can buy. All right, this car has got to be north of $100,000 for this vehicle. It just has to be. For an American-made car, that's a heck of a lot of money. I'm sure you know. Well, why does he have that car? Well, he's hustling people around that are literally millionaires, all right? And he's driving them here and driving them there, and these are people that are not familiar with the area because they're coming in from out of town usually, not always. And so, they want to be comfortable and they want to feel like they're being like they're getting, treated like royalty, like they think they are, right? And so it is perfectly legitimate for this guy to have that high-end SUV to hustle those people around. Now, on the other hand, again, if you're the home-based IT professional and you build websites for people and you spend 6 or 7 hours a day in your home office building websites for people, why do you need a $100,000 Cadillac SUV to run around town to go back and forth to the bank? You don't. So under those circumstances, it would not be reasonable to claim a business expense for that vehicle. You can buy the vehicle. Of course, no one's going to stop you from buying it, but it's not going to be tax deductible based on the reasonableness and ordinary and necessary test. The things to keep in mind, 3 things to keep in mind for business expenses, and this rule applies across the board, right? The expense has to be incurred for the purposes of earning income. That is to say, there's got to be a business associated with it. Number 2, the expense has to be ordinary and necessary based on the nature of the business. And then number 3, the expense has to be reasonable. So as long as you can answer those questions affirmatively to the IRS, yes, my business is producing income, here's how. Yes, it's ordinary and necessary, here's why. Yes, it's reasonable based on the circumstances, here's why. You get the tax deduction. But when we're talking about vehicles, you still have to do that business use, personal use delineation.
So, I would guess, though, in a situation where all this gets brought up as in an audit, the IRS audit happens.
No doubt. And if you have a properly trained tax professional doing your tax return, all right, that professional should be asking these questions so you don't make a mistake on the return going in.
But at the end of the day, it's all subjective. I mean, the IRS agent goes, I don't think I agree with that.
Well, I don't believe it is subjective, Bob, and I'll tell you why. Let's just talk about the ordinary and necessary test. Mm-hmm. The IRS doesn't get to decide what's ordinary and necessary. There's no rule in the Internal Revenue Code that says it's ordinary and necessary if, and if. There's no such rule. The taxpayer gets to decide what's ordinary and necessary. Now, the tax auditor can disagree with that, and they often do, but you generally almost always will win that issue on appeals. It's the taxpayer that gets to decide what's ordinary and necessary for their business. But now remember, we got to pass the reasonableness test too. So, I determined that this $200,000 SUV is necessary for my business. Well, okay, is it reasonable based on what's going on here? And so, yeah, in that sense, there's some subjectivity. That's true.
Oh, Dan's website is taxhelponline.com. Go check it out. There's a lot of free information and everything that he has written about the IRS. If you have an issue with the IRS, he's got a book about it. So you can go check that out, taxhelponline.com. Dan, time goes by way too fast. It's great talking to you.
All right, my pleasure, Bob. Looking forward to next time.
This is Bob Brooks, and you have been listening to the Prudent Money Radio Show. If you got a question for me, please go to the website at prudentmoney.com and send it in because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.